So in this video, we will go through the teachings of Warren Buffett and what we can learn from his teachings on investments. So what is the game of investing, right? What's the game? So the goal here is wealth creation. And how are we going to create wealth? It is through compounding for long term. And what is the means of compounding? It is through stock investments. So stock investment is a means, but what we are trying to do is compound money for long term. And compounding money for long term means we should compound money in such a way that we don't have major losses. Not having major losses is very important if we want to compound it for long term. Now, there are two types of stock investments. The first is where we are buying the undervalued stocks and then we sell when they are fully valued. But here we have to keep finding new stocks once we have sold the undervalued stock when it got fully valued. The second approach is where we buy great companies at fair price and then hold them for long term because we don't have to sell them. Great companies will keep on compounding. So this particular video is mainly for the second approach, which is buy great companies at fair price. So how do we identify great companies? Great companies will have great product or services and they will have long runway of growth. They will have durable competitive advantage, and that competitive advantage ideally it should keep on increasing with time. And finally, great company should be run by great management. Great management is very important as far as investment is concerned. So how do we identify companies which have great product or services? They will have great brand, or they could be lowest cost producer also. Normally they will have a domination in the market in which they are operating, and their product or services would have become a reflexive choice for customers. And the rare possibility is that it has become an addiction, like gaming company or liquor company or cigarette company. Long runway of growth means existing customers will consume more and new customers would join and buy the product, and there would be new untapped markets. So what are the other characteristics of great companies if you want to indirectly identify them? So normally they have high return on capital. They will have high gross margin compared to the peers. They would be dominant in their sector. And great companies, they generate lot of cash. And they can comfortably raise price. This is very important. If they can comfortably raise price, it indirectly means that the product is great, customer likes the product, and the overall dynamics is such that the price rise does not affect the demand. And because they generate a lot of cash, they normally have low or no debt. And these companies normally would have handled their downturn better. And very good to have is a company which is so simple and so strong in terms of brand value and demand that any idiot can run it. And they can deploy incremental capital, new capital at higher rate of return. And if the company is truly great and simple, then we should be able to identify one or two variables which determine the profitability of the company. If there are only one or two variables which determine the profitability of the company, it makes it simple for the management to focus on them. Now, coming to how to identify great management. So, great management, there would be a fanatic CEO and there will be proven track record of the company. The company will have great culture. Great culture means customer focused culture. Company would be good at capital allocation and they would have conservative accounting. And the CEO and the top management, they understand the brand. They understand their own brand, how to make it stronger. And they are able to focus on key variable, what is important for the company. They have identified that and they are fully focused there. And they are resistant to institutional imperatives, means they are not so much influenced by social proof that what other companies in the sector are doing, they are also doing it. They are not taking any shortcuts to increase their sales. They are good in their reporting and they have conservative projections and they are willing to invest for long term sustenance of the company. Now, identifying great company is not that difficult, but we have to buy them at fair price. So when we intend to buy them at fair price, what it means that we are not trying to buy them at the lowest price possible. And we have a sense, ballpark valuation number, what the company valuation should be. And there should be margin of safety when we are buying them. And when we are buying them, we should buy meaningful quantity because great companies at fair price is a rare opportunity. And we should be okay holding that company if the price goes down because we are not buying them at the lowest price, we are buying them at the fair price, and if price goes down we should be okay with that. And ideally we should be able to buy more if the price goes down. Now when we take this approach of buying great companies at fair price, the price will not keep on increasing every year. So we will not compound every year. Okay. And it's okay. That's how it should be. That's how the game will be because even great companies will not always keep on increasing the share price. Their share price will not keep on increasing every year. Now it is coming to the important part, which is, let's say you have identified great company, you have bought that great company at fair price, then what should be our focus, what we should do? So once we have invested in great companies, we should hang on to the share like you hang on to your dear life. And it will not go up every year, so don't focus on price. We should focus on operational result. And even operational results also will not keep on going up every year. We should be vigilant about the moat of the company as well as the management if there is any change into that. So once we have bought great company at fair price, don't look at the market every day. Don't look at your portfolio value every day because it will keep on fluctuating. Don't worry about macro factors because when we are buying great companies, we are buying based on the company fundamentals, strength of the business model. And don't listen to the TV commentators because they almost always, they focus on sensational. Instead, what we should do is we should read business newspapers, business magazines, annual reports, and business books or autobiographies. That should be our focus or routine. Now, it's important to not have major loss. We must avoid permanent loss of big capital. And for that, we should not leverage and we should not create huge position in a single stock. Don't put 50%, 100% into a single stock. And very important, don't exit at the bottom of market panic. Now, the strategy is simple. Identify great business with great management and wait for the fair price and then buy meaningful quantity. But this is something which is, despite being very simple, it is extremely difficult for most people. Mainly because we have temptation for easy money. We think market can make easy money for us. So we tend to chase what is going up. And second is we don't have patience. We don't have patience to wait for the fair price, for the great opportunity when it comes to buying, and we don't have patience to hold on to it. So other difficulties are that great companies are well discovered. And because they are well discovered, everyone knows that they trade at higher multiple, which means they are expensive. So we get to buy them at fair price very rarely. That opportunity would be very rare. And it normally occurs when a great company has one time fixable trouble and there would be bad news everywhere around and price would have fallen significantly, or the whole sector is neglected by the market for whatever reason because something else is exciting and tempting. And the third possibility is when there is a fear and panic in market and everything is crashing. This happens every decade or few decades, like 2008 crisis or corona crisis and panic. So basically, we will get the opportunity to buy great companies only when the market is not favoring them and there is a bad news. So we can have the clarity, willingness, and courage to buy them when there is negative news only when we have kept money separately for investment. And we are not fearful because our existing portfolio might have fallen big. This is especially true if there is a fear and panic everywhere. And we should already have identified great companies beforehand. And we should know what is the fair value of these great companies which we want to buy. And then we need to have courage to invest when there is a bad news everywhere. So we should be basically mentally prepared for utilizing that fear and panic as an opportunity to buy great companies. So that is possible only when we develop the mindset where we are happy when there is a pessimism and bear market is going on and price is falling every day gradually, or when there is a big crash because of some big event or news, and big crash is causing fear and panic, and fear and panic normally spreads like wildfire and everything will start falling. So when that is happening, we will be able to take advantage of that situation to buy great companies only if our existing lifestyle and reputation is not under threat. It should not happen that all your money is fully invested in the market and market has crashed 30-40%, your portfolio has come down 30-40%, and you are worried about your next expense. Second is, there should not be any permanent damage to economy or market system. Third is, we should be comfortable about our existing portfolio which would have gone down, and we would have saved enough money to buy at such point of time. So basically we need to reorient our lifestyle as well as mindset so that it allows us to benefit from such market crash. And it is also important that our existing portfolio consists of very strong companies where we are not worried about when market is falling and their stock price is also going down. So let's look at some of the key principles or rather facts of stock market investment. So the first thing is, when it comes to investment, it is not necessary to do extraordinary things to get extraordinary result. Basically, we don't have to try to be brilliant and try to solve tough problems here. The second important principle is the value cannot grow faster than earnings. So basically, earnings growth determines the value of a company, and stock price will more or less follow the value. And price may go up or down, deviate from the value, which is what market does, but our overall focus should be on earnings and value. Third is, do not buy something you can't hold for 10 years. This is the attitude which we want to develop when it comes to investing for long term. Buying price is very important. What it means is, even when we are buying great companies, it is important that we are buying them at fair price, not at a very high valuation. There is no certainty in the market. Market macro can change very quickly, very fast. But the good news is volatility is not risk. Risk is loss of capital permanently. Another thing is that every once in a while, in a decades, there would be extreme fear and panic in the market. So this is also more or less like a fact. So we'll see how to utilize these principles, okay? Another thing is you will make mistakes. So when it comes to investment, there is no certainty and we will make mistakes. It's not like that we will make no mistake and we will be right 100% of the time. But it is important that our mistake should not be catastrophic. It should not be something where we are losing big part of our portfolio money permanently. Don't count on getting rich twice means once you have decent size of portfolio, it is important that we focus more on protecting the downside rather than focusing on making the highest return possible. So let's look at them in detail. So it is not necessary to do extraordinary things to get extraordinary results. What it means is we should buy simple business. Great business, normally they are simple to understand, simple to know which are the key variables which determine the profitability and growth of the business. And we should focus more on management of risk, not on return, because return would take care of itself. Our job is not to worry so much on return. Our job is to manage the risk. Once we have bought great companies at fair price, the return will come on its own. We don't know when it will come, but our focus should be on management of risk. And third thing is you don't have to make money the way you lost it. So if you are proven wrong, accept your mistake and move out. Don't try to average it or don't try to make recover your loss. Next is value cannot grow faster than earning. It means we should focus on earnings, profit. We should be focusing on value. What should be the valuation of the company? And we should not focus on the stock price. Do not buy something you can't hold on for 10 years. And this looks like a very tall ask, but that is why we are buying great companies because they can compound for decades so that we don't have to keep finding newer and newer companies every year. So buying great companies which we can hold on for at least 10 years, that should be our filtering criteria. The game is to recognize a good idea when you rarely get it. Great business at fair price. This is the game. And time is a friend of great business. That is why we can hold on for 10 years. And we don't have to find them very frequently, even though we have to keep on working every day. If we find 2 3 such investment in great companies, they are sufficient to make us rich. Don't pass up something that's attractive today because we think we will find something else, because finally you are in stock market, right? There is no certainty here, and we are not trying to buy at the lowest price. That temptation we have to give up. And time to be interested is when no one else is interested in the stock. That is how we find great companies at fair price. Next principle is buying price is very important. Do not count on selling higher. You are buying great company thinking that price will keep going up and I will be able to sell it higher. That is not the strategy which we want to adopt, because what is smart at one price is dumb at other price. So even great companies at higher valuation, very high valuation, would be a very dumb investment. There is no certainty in the market. It is a game of probability. That means the price will keep on fluctuating, and price normally um, keep deviating from the value on higher side as well as on lower side. So that is why risk management should be our focus, and it is important. Volatility is not risk. Volatility means price fluctuation going up and down. That is not risk. The risk is permanent loss of capital. And the second risk is generating inadequate return on capital. So we need this change in mindset where volatility is not considered risk and rather it is seen as an opportunity. And every once in a while there would be extreme fear and panic in the market, because that is the nature of stock market, because macro factors and events keep on happening, and every once in a while those kind of situations will happen. So when that happens, it is important to remember that widespread fear is your friend as an investor, and personal fear is our enemy as an investor. And we will make mistake, because we are human beings and we are not Warren Buffett, right? So we will make mistakes. We should recognize it and correct it fast and move on. We should not go into denial. We should not stake our identity, our ego into being right or wrong. If we made a mistake, recognize it fast, recognize it, correct it fast, and move on. Don't dwell on your mistakes. Don't count on getting rich twice, means don't make blunders in investments. You have to get rich only once. So avoid catastrophic mistakes. So now let's look at some of the personal traits which we need to develop so that we can align ourselves to these teachings or learning or frameworks. So personal traits which we need to develop, first is don't fool yourself. We'll look into all of them in details. Second is you have to think for yourself. Be a business analyst, not a stock analyst. Have no pressure to buy stocks. Protect yourself from market euphoria. Have patience to wait for right opportunity. And have courage to buy at the time of crisis. Okay, these are the personal traits. So the first one is don't fool yourself, means don't think there is a easy quick money to be made in market. And every once in a while people do make easy quick money in the market, and most of them they lose that money in the market. In the market, we have to understand what the game is and we have to do our own thinking. Our own thinking. You have to think for yourself means we can't look for validation from others on our point of views. I have to understand what I want to invest. I can't rely on any other analyst or fund manager. I can't simply invest because I think someone else has recommended, someone else has provided rational and reasons, and therefore I'll go and invest. And finally, don't blindly trust the management of the company. Even whatever management is saying, we need to cross validate whether it is reflecting in the numbers and the choices they are making. So how to look at stock market? This is where very fundamental change is needed because normally stock market is viewed as gambling where we can make easy money if we time the market correctly. But we have to see stock market as it is a mechanism which is providing us the opportunity where we can partially own wonderful businesses because we can't buy wonderful businesses completely because they are so big we don't have that money, but at least because the stock market is there are shares in the market, we can buy shares of great companies and therefore partly own them. And share market also provides once in a while opportunity where these great companies would be available at fair price. The next is we should become a business analyst, not a stock analyst, because stock on analyst is mainly focused on price and never invest in a business which you don't understand. Have no pressure to buy because normally we approach stock market for easy money, then we are exposing ourselves to the temptations, we are exposing ourselves to the FOMO, and we keep putting pressure on ourselves to keep buying stock. The important is to come to that mindset where there is no pressure to buy. Don't chase what is hot. And normally there would be stocks which would be going up 10%, 20%, which would have gone up twice or three times in 6 months. Don't chase what is hot. Every day, just assess the opportunity. And we have to focus on great companies. Invest only when the opportunity is great. Great company is always available, but opportunity comes when the price is fair, which happens very rarely. Otherwise, do absolutely nothing. And this is not easy for 99% of the people because waiting for months and years and then do only one investment, that is not easy for most people's temperament. So I think the most important temperament for investor is to protect ourselves from market euphoria because uh, there are many temptations which will come into the play here. Because whenever there is a euphoria in the market, lot of people would be making lot of money, and that would appear like easy money and I have missed out. There would be time when investment in great companies would look like appearing stupid to other people because all other people are making 50%, 100% money in a year. So there would be incentive, temptations. There would be envy and jealousy because other people are making money. There would be deprival super reaction. And there would be authority because many people in the TV and other places would be coming and talking about other stocks. Then there would be social proof because everyone else is getting affected by euphoria and investing on stocks, and those hot stocks would be going up further, and that would be creating deprival super reaction. And then there would be extra vivid impression because everywhere in the TV and news channel there would be news that this stock has gone up 5 times, this stock has gone up 20% today, and so on. So it is not going to be easy to protect ourselves from euphoria. But at the same time, it should not be very hard also because if it is very hard, that means you are already triggered emotionally. Okay. And then you will be fighting your emotions, and no one can win against their emotions. So if emotions are already triggered that I should buy the hot stocks which are going up, then you will not be able to fight against those emotions. Getting triggered means you are seeking easy money. After all, the only reason you want to buy hot stocks is because they are going up and they are already probably very expensive. And if you are getting tempted to buy, that means you are basically seeking easy money. So, not getting triggered is the acid test of your faith, belief, and conviction on your approach that my philosophy is to buy great companies at fair price and it is not going to go up every year, and that's okay. Right? So that is the philosophy which we are discussing in this whole video. So what we really need is the patience, and patience is not something where you are just fighting against your emotions, right? We have to be disciplined that I'm not going to be tempted by easy money. I'm not after easy money. I will invest only in something which I understand and what makes sense rationally. And we need to really understand that even though there would be many hot stocks which would be going up, but really long term wealth creation happens when we wait for the perfect opportunity. Long term wealth creation happens in great stocks, and we have to wait for the perfect opportunity. And also, you are not trying to prove anything to anyone that I'm a great investor and I'm making money every year and I'm beating the market and I'm better than others. You're not trying to prove anything. Your identity is not attached to this that you are proving yourself through stock market. And all this is possible when every day you have something to look forward to. You are busy doing something you love, and you are not getting bored in life. Your life is more or less sorted out. You are not getting bored and seeking excitement in life, and therefore you are looking for some kind of excitement in stock market. Finally, courage at the time of crisis is the most important thing, because the crisis in stock market, fear and panic in stock market, that is the rare opportunity, and that is when we have to really act, and that requires courage to invest at that time. And for that, we have to be free from market contagion, because market will have fear and panic, and it will be spreading like wildfire. And courage will come only when you have money to invest. You have kept some money aside, which you are waiting for the opportunity to invest. And at the same time, you are not fearful and panicking about your own portfolio going down, because when there is fear and panic in market, your existing invested portfolio would also have gone down. And you already know, and waiting for such crisis as an opportunity to buy great companies which you have already identified, and you know the fair value at which you would like to buy those companies. So finally, you have to decide who you are, and you should be interested in being right about your assessment of the business, your understanding of the business model, how strong the business model is, and how accurate is your assessment. That is where your interest is. And you must enjoy the game also. If you don't enjoy the overall game, don't manage money. Definitely not manage other people's money, and probably you should not invest and manage your own money also. We should be interested in playing the game and not so much on its outcome. Outcome should take care of itself if we are following the rules of the game and playing the game by its rule, because we are enjoying the game. And money, which is the outcome, is going to be a positive reward, and it would be great to reinforce this overall willingness and excitement about the game. But the focus should not only be about making money. The whole point here is that unless you enjoy the game playing by its rule, you should not manage money. So the real question is, do you really enjoy the game, which is about identifying great businesses and waiting for the opportunity? So that's all. Thank you for watching this and listening to this video. Have a nice day.